Nvidia, once known for graphic cards, now the most valuable company on the planet, and it's all thanks to AI. As it turns out, these same chips used to run games are incredibly useful for training AI. So as companies started to spend billions on AI infrastructure, Nvidia's dominance in GPUs made it one of the biggest winners. Nvidia's stock gained more than 24,000% over 10 years to February 2026. That means $100 invested back then would be worth around $24,000. Its rise has made it so huge that now is part of the Magnificent Seven, a group of incredibly valuable tech stocks that includes giants like Apple, Microsoft, and Alphabet. Together, these companies make up roughly a third of the S&P 500, which is one of the main benchmarks people use to measure the U.S. stock market. Nvidia alone now makes up around 7 to 8% of that index. That is one of the largest single company weightings ever, and it means the stock performance affects the entire market. So if it keeps rising, it can help push it higher, and if it falls, it can keep dragging everything else down with it. This is what's known as a concentration risk, when too much of the market depends on too few companies, and it's a big reason why some investors worry the AI boom could soon become the AI bubble. But despite the huge run-up, some analysts still see room for the stocks to go even higher, because demand is really off the charts. So let's take a look at what's driving it. Well, training an AI model takes huge amounts of processing power. Systems have to work through massive amounts of data at speed, which is exactly the kind of job Nvidia's GPUs are built for. So when companies started spending billions on AI infrastructure, Nvidia was in the right place at the right time with the right technology. The company still sells graphic cards, but today, data centers are the real moneymaker. In its last quarter, Nvidia brought in a record revenue of $81.6 billion, up 85% from a year earlier. Its gross margin was around 75%. So Nvidia isn't just selling a lot, it's selling with huge margins. That's why investors are so excited. The bull case is simple. AI needs compute, which is the processing power AI systems require. Compute needs chips. And right now, Nvidia is one of the few companies that deliver at the scale required. This is the classic gold rush idea. When everyone's looking for gold, the more lucrative business is often in selling the shovels. But Nvidia doesn't just have a hardware advantage. It also has CUDA, the software platform developers use to run its GPUs. That ties many companies into Nvidia's ecosystem. So switching away from that isn't exactly easy. That's a powerful position for Nvidia to be in, and that's why investors are willing to pay premium for the stock. By 2026, Nvidia has become the first company ever to cross a $5 trillion market cap. Its P/E ratio was in the low 30s, which is high, but not outrageous compared to some other mega cap names like Apple and Tesla. Now, a high PE isn't automatically a red flag. It compares a company's stock price to its earnings. If earnings keep growing quickly, the valuation becomes easier to justify. But that's also the risk. A lot of future growth is already priced in, and when expectations are this high, even a good result may not be enough. So investors aren't just expecting Nvidia to grow, they're expecting it to keep smashing records. So what could threaten that? Well, first, there's competition. AMD is the main challenger. Its stock recently hit record highs off the back of AI-driven demand. Nvidia still leads, but if rivals start catching up, that could put pressure on its margins. Then there's customer concentration. A lot of Nvidia data centers' revenue comes from a small group of large tech buyers with deep pockets. If they keep spending, Nvidia benefits. But if they slow down or start questioning the return on all that AI spending, Nvidia would feel it and feel it fast. There are also geopolitical risks. The U.S. and China are locked in a race for AI leadership, and advanced chips are right in the middle of it. The US has already restricted some Nvidia sales to China, and any trade tensions or lingering uncertainty can hit future demand. So what should investors watch? Well, data center revenue tells you a lot. We've seen how huge it has become. The question now is whether it keeps growing. A lot of that does depend on big tech continuing to pour money into AI infrastructure. Margins matter too. If they start falling, that could be a sign that competitors are catching up, costs are rising, or customers are pushing back on price. And also listen to what Nvidia says about what's coming next. Right now, the company is forecasting around $91 billion in revenue for the next quarter, which shows it still expects demand to stay strong. Okay, so we've covered a lot in this video, but what is the main takeaway? Well, Nvidia is now the #1 company powering the AI boom. It has massive demand, sky-high margins, and market position to show it. But the stock has already priced in a lot of that success, and that's the trade-off. Huge opportunity, huge expectation, and very little room for disappointment. But of course, the market is bigger than just Nvidia, so I'm looking at you. What is your take? Is Nvidia still the best AI play, or do you think there are better opportunities out there? And let us know which stock you'd like us to cover in the next video.